Well, it is never too early to rate a stock. The first firm to call Facebook shares a, quote, sell is Pivotal Research Group. Senior research analyst Brian Wieser did so a couple of hours ago, and he joins us now from Portland, Oregon. Brian, your 12-month target is $30 a share. Just for the benefit of our viewers, lay out the bear case, please.
Sure. Well, we think there are several concerns that have to be accounted for on a risk-adjusted basis. Simply, Facebook is a risky stock, and those risk factors are really driven by the fact that the ad model is as yet unproven. Although it's very promising, over a long term, it is not yet a proven business model. We know that the operating costs are certainly rising and are likely to keep going up as the company continues to focus on large brands as a primary means of monetization. That's a good thing, by the way, but it's going to be expensive. We think that the capital expenditures are high at $2 billion a year, likely this year, 1.8 maybe, but rising on an ongoing basis as the company continues to focus maniacally on customer experience and consumer experience. So that number is not going to be low. Take whatever your EBITDA number is, but you've got to take the CapEx out to get to the cash flow. Then you've got acquisition risk. Instagram was the first of possibly many. Facebook is essentially in an arms race with Google. So we expect that more multi-billion-dollar acquisitions will come, and not all of them will have any revenue. And then lastly, there's an overhang of shares out there. There are about 1.8 billion shares that are currently locked up, and those restrictions will come off over the course of this year.
You know, Brian, shares ended just barely above where they came out at $38 a share. They ended at 38 and change. What's your price target on this company? How far do you see it going lower?
Well, we see $30 as meeting a fundamental valuation. Now, that's not to say the stock doesn't move around that, above or below for that matter. We use Google as a reference point. We have a buy on Google, $820 price target. We assume that Facebook grows faster and is a little bit riskier, so a slightly higher discount rate for our cash flows, and we get to a $30 price target. Google is not trading at $820.
But hang on, explain to our viewers, Brian, what sort of cash flow, first of all, what the cash flow is, and then number two, what the multiple is on that cash flow that ultimately gets you to $30, which is really Twish's question.
Yeah.
Oh, sure. So we've assumed that they're growing the revenues at about a 30% rate every single year. And we're assuming that their margins are around 40%, but declining over time, right? And so you play that out to 2017, you'll get about $5 billion of cash flow, but we use about a 20 times multiple against that, and you discount that back to the present using, we use about an 8% discount rate to get to our valuation.
And by the way,
so we look
the 20 multiple on that cash flow, where does that come from?
That's just a function of our expected growth rate offset by the discount rate, the risk. So we're assuming that they can grow in perpetuity about 7% every year as far as history goes. And at the same time, we're assuming about a 13% discount rate. And 13%, all that means is that if we think that the company's going to generate $5 billion of cash 5 years from now, 13% is the rate of interest we're applying against that to bring that number back to the present.
13% sounds incredibly high in an environment where a 10-year yield is 1.7, though.
This is a very risky company. And but for Google, to be clear, we're using an 11% discount rate. And with an 11% discount rate, we get to an $820 valuation on Google. It seems inconceivable to us how Facebook could be above $30 and Facebook not be $820.
But Brian, let me play devil's advocate here and talk a little bit through some of the points that Sam, who was just on, and had bought Facebook at $2 a share back in 2008, now has a $200 million investment, didn't sell one share today. And his whole premise is that this is a growth engine. This is changing the world as we know it, and that the ability to monetize all of our data online for Facebook is so tremendous that he only sees upside going forward. What do you say to the enthusiasts like that, like Sam, who believe in what Facebook is doing?
We agree, but it's at what price? The question is, what's the appropriate rate of discounting the future cash flows? At the end of the day, again, we're arguing that you can make the same case around Google, right? And we think Google is a less risky story because so much of Google's business is known and understood. So you can't have both things be true. If you think Facebook should be a $40, $50 stock, Google is a $1,200, $1,500 stock.
And Brian, is there anything, before we let you go, is there anything that might cause you to change your assumptions lift the sell, up the target, et cetera?
Well, our target is where our target is, but I think it comes down to really de-risking the company in so many ways. That's not necessarily a wise thing for what is still a company behaving like an early stage venture-funded company. They need to work in this uncertain environment because they're trying to figure out something that's durable and will last forever. That's fine, but it's risky. And so if they did things like they became a very, very large company that had very predictable cash flows, that would change the riskiness. That would bring down the discount rate. And if they could keep growing in a non-risky way, well, of course, it would cause our stock price to go up. If we knew that their capital expenditures were not $2 billion and rising per year, we'll wait a couple of years before we really know how much CapEx they need to spend to support this business. Remember, they're spending billions of dollars on data centers and associated real estate to support the consumer experience.
All right, Brian Wieser of Pivotal Research, the only guy with a sell. There have been a lot of naysayers out there. We appreciate your coming on and actually talking us through the numbers behind your sell. Thanks, Brian.
Dose of reality. Okay.